All right, let's go ahead and get started. Again, thank you very much and good afternoon. Welcome to another Fast Track webinar. I am Peter Benjamin. I couldn't be more excited to moderate the session. Before we get to the meat of today's webinar, let's start off with a few housekeeping items. Today's session is being recorded and will be posted to our website in the coming days. I will be monitoring the Q&A, so feel free to ask questions and I'll do my best to weave them in. And finally, registration for our annual conference coming up this September is open. This is shaping up to be the largest event that we've ever held, and you're not going to want to miss it. In fact, today's special guest is one of our featured keynote speakers, and I would urge you to register today so you don't miss out on listening to him on not just his amazing insight, but that of many of our other amazing speakers. Before we jump in, a quick disclaimer. The views and opinions expressed during this webinar do not necessarily reflect the views or positions of Acuma, its board of directors, its management staff, or its members. The webinars and its materials are presented as a set of ideas and possible strategies regarding its specific topics and do not represent any endorsements of either the presenters, their firms, or the concepts they present. Okay, that's all for now. Today's webinar is being brought to you by Constellation Mortgage Solutions. Joining us today is Kelly Hembaugh, Chief Revenue Officer. Kelly, welcome. Why don't you join us on stage? Thanks for being here. It's good to see you.
It's good to see you. Thank you, Peter.
Of course, my pleasure. All right,
always.
So do me a favor. Would you start off by giving us a brief overview of Constellation Mortgage Solutions?
Oh, I would love to. So thank you again for the warm introduction, the opportunity to be part of the webinar today. I'll just start off by sharing that for more than 20 years, CMS has provided innovative technology solutions for mortgage loan origination and loan servicing. It's really designed to deliver exceptional loan quality and regulatory compliance. Kind of fast forward to today, we deliver these services through our new award-winning LOS Nova that we were excited to release in 2023. And that tags along with our loan servicing solution and reverse vision that Constellation acquired in 2022. We basically say our special sauce is delivering enterprise technology with experience from point of sale to post-closing for mortgage teams to operate at really high efficiency and stay competitive in the small to mid-tier market space that traditionally only the largest of mortgage lenders could always leverage.
That's awesome. Now, what are some of the key features that kind of sort of set Nova apart from other loan origination systems in the market?
Well, we only have so much time, and Nova has so many great features, but a few of these features include our cloud-hosted web-based platform that has a new modern user interface experience. One of the most unique benefits in Nova is the ability for each of our users to create their own dynamic workspace to manage their daily work, keeping those loans that need the most attention front and center. And for the managers and executives in the credit union, Nova has a dynamic business analytics reporting solution built right into the platform that provides not only live dashboards for each user, but also real-time reporting across the entire mortgage department. And it can also be used to aggregate data with other technology solutions within the credit union that contributes to overall operational success.
Okay, great. Here's the million-dollar question. How does Nova specifically cater to the unique needs of credit unions?
Well, CMS knows that credit unions operate with a strong focus on member service and community values, which means they need flexible and member-centric systems. Nova's designed with these principles in mind, giving customizable workflows, a user-friendly experience, along with a highly configurable administration module that can be managed by the mortgage operations managers without the need for expensive IT and development resources. So this allows the mortgage team to make needed changes quickly to stay on top of personalized member service and provide that peace of mind of maintaining regulatory compliance and operational efficiency.
Yeah, that's great. That's great. Now, where do you see CMS and the Nova LOS having an operational impact for mortgage lending after the previous 2 years of record market declines?
Yeah, Peter, we've certainly experienced the crush of the market downturn with lower volumes impacting profitability. And also, sadly, the shrinking of a lot of mortgage teams out there. Partnering with Nova will give credit unions that ability to implement modern origination technology in as little as 6 months by leveraging our high configurability rather than paying some of the high costs associated with project management, IT, and a lot of development resources. In addition, these operational lifts that Nova provides will allow mortgage teams to not have to add more FTEs as the market recovers and we see those loan volumes return. So this delivers future profitability and also a good return on investment by partnering with us.
Sure. All right. It's this seems to be a constant conversation that we're having. Technology continues to change, and really at a rapid pace. How is Constellation Mortgage Solutions staying ahead and continuing to innovate?
Well, our commitment to innovation is unwavering. You have to be to keep up. We foster a culture that encourages new ideas. We're investing significantly in our product solutions every single year, even with working with the downturns. We engage with all of the regulatory agencies on a regular basis to stay ahead and have a voice in those upcoming regulatory changes. We also actively seek feedback constantly from our clients and our vendor partners, which we then use that to refine our solutions and ensure that Nova, along with our other products, is always evolving to meet the changing demands of the market.
Well, Kelly, thank you again. I truly appreciate your time today, and thank you again for sponsoring today's session.
We were happy to do it, and we'll look forward to seeing you guys in Las Vegas.
Awesome.
Bye.
Fantastic. Thank you.
Take care, everybody.
Again, it's my pleasure to welcome today's expert, Logan Motoshami, lead analyst for Housing Wire. Logan, hello and welcome.
It is wonderful to be here.
Excellent, excellent. Now, Logan, normally I have a long lead-in, kind of painting a picture of various things, various topics that I want to discuss, but I think it's just best to kind of just jump right in, if that's okay.
Sounds perfect. Let's go.
All right. First things first. Before I kind of get your opinion on some things later down the line, I think it's best to kind of set the stage and break down housing data to kind of start off with. So I'd love to get your opinion on those things later, but first things first, the data. Let's break down data. The Fed. I know it's one of your favorite topics. I listen to Housing Wire daily on a regular basis. I know you love talking about the Fed. I want to know get your perspective on the Fed and where you foresee rates going. Now, the Federal Reserve meeting, we know that they're meeting two more times, late July and mid-September. Really, and it's going to happen before the November presidential election. Do you see the Fed cutting rates, at one of those two meetings? What impact, if any, could that have on mortgage? Could there be some type of possible changes in the summer, late fall? Now, Freddie came out saying that they're now only predicting possibly only one rate cut. What are your thoughts?
So the Fed isn't as relative to what's going on now as the labor market. So I go back to toward the end of 2022, and I believed in this premise that the Federal Reserve is not going to pivot until the labor market breaks. So I think what's been confusing for everyone is that they see the growth rate of inflation fall a lot. I mean, CPI was running at 9%, it's at 3.5%. The Fed talks about PCE inflation at 7%, and it's 2.5% now. But rates haven't really come down. And to me, it's the labor market. The Fed has this old model of attacking inflation, and it's really attacking the labor market. So there's certain job numbers that they wanted to see first before they could start talking a little bit more dovish. But the bond market itself will kind of get ahead of the Federal Reserve. That's the key. already in the last 2 years, we've seen over 1% declines in mortgage rates, and the Fed was one time still hiking, and the other time the Fed wasn't cutting, it just stopped hiking rates. So to me, I always tell people, focus on labor data. The labor data has been getting softer for many months now. And now the Fed is starting to move toward okay, we've got supply balance with the labor market, wage growth is coming down. And if the labor market deteriorates more, the 10-year yield will go lower, mortgage rates will go lower. The Fed is by nature old and slow, right? So they're going to come after the fact. But maybe the peak in the 10-year yield already has now given us something to work with. If job openings keep on going lower and jobless claims start to rise, mortgage rates will go down lower by itself well before the Fed will cut rates. But I always focus on the labor data more than the inflation data.
Now, okay, talking about mortgage rates, obviously you're constantly changing your models throughout the course of the year. Freddie recently published, their mortgage rates, and they kind of said that they do not foresee, mortgage rates dropping below 6.5 at the end of the year. MBA did the same exact thing. They said 6.6 at the end of the year. Where do you foresee mortgage rates kind of sort of ending at the end of the year?
I absolutely detest mortgage rate forecasts. They
Come on,
just do these
give me
things.
something.
They
Give me
do.
something.
No, a forecast is something that they put out early in the year and then they update it. I always say when I do my forecast at the start of the year, I give people ranges. So 5.75 to 7.25 should be the range this year. But if the labor market starts to break, we're going under 6.5. And then all of a sudden, if the spreads get better, and this is the key, mortgage spreads have gotten better this year. They're not back to normal, but if we had had the spreads of last year, mortgage rates are 0.5% higher already today. So the mortgage spreads are getting better by themselves. So that gives us a little bit of better mortgage rate this year. But if the labor market starts to break and the 10-year yield could go lower, if the spreads get better, we're easily 6.5 and under. And that sticks into my forecast range for the year. The reason I don't like just a headline forecast is because I teach people every single day what to track and what data line matters for rates. So when we start to see things softening up on the labor side, that's when you could kind of get ready for maybe rates to go down and actually stay down. We've had these big moves up and down on mortgage rates because the labor market wasn't breaking before, not in 2022 or not in 2023. But now the labor market is getting softer. But if jobless claims start to increase, then hey, listen, we are talking about sub 6% mortgage rates at that point. If the spreads get back to normal, the spreads is the difference between the 10-year yield and 30-year fix. Historically, going back to the early 1970s, it's about 1.6 to 1.8%. We got up to 330, so mortgage rates are higher than what they should be normally. You could get, sub 6% mortgage rates this year. It's just the labor market is the key to everything. There's a jobs week where we get 4 labor reports on one week at the end of the month, and then there's jobless claims data. So we're no longer in a tight labor market, and the Fed knows this. So this is something about how we can think about in the future, where I didn't think that was the case in 2022 or 2023, but now the labor data are hitting the metrics the Fed wants, so they can start to be more dovish going out in the future.
Can we? I do want to expand on that labor data a bit more, but before we do that, I kind of want to expand or ask one more follow-up question on mortgage rates. Do you agree, kind of like that 6.5 mark kind of signifies kind of or triggers that a massive refi boom or could? I'm not going to say massive, but a mini refi boom.
So whenever you get 75 to 1% lower on rates from the peak, you can naturally get more supply of refinances to work with. We weren't at 8% mortgage rates long enough to create a big supply of loans but when you start to get in the 7.25 and 7.5, you got a lot more potential business coming down the line. So I would say about 6.125 to 6.25, you get a bigger pool of potential rate and term refinances. And then after that, that pool should just get bigger and bigger and bigger, especially if you get to the low 5s. If you can get to the low fives, then all of a sudden the last 2 years of all the purchases that were done, or all the loans that were, temporary buy downs, they all become into play, right? So you need the labor market to get softer and break for that to occur, and for that to stick in there, because housing's been disproportionately hit on the negative side for like 3 years now. So the potential for things to get better is higher here in this sector, because total net volumes are so low. But labor market has to get worse and worse, and then you don't even have to wait for the Fed. The 10-year yield will go down by itself, just like we've seen in other periods in the last 2 years. The bond market wants to get ahead of the Fed, and the moves can be very fast. But unlike the last 2 years, I do think that the labor market is softening enough to where the Fed, even one of the Fed presidents just yesterday talked about, we're starting to get to the point where we need to be maybe a little bit more mindful of the labor data, something they've never talked about in the last 2 years.
Okay, so kind of sticking with labor data, this was on my list. I'm kind of jumping ahead, but I'm glad you brought it up. Relatively recently, the Labor Department released the results of their quarterly consensus of employment and wages, which led many to speculate that not as many jobs were created in 2023 when compared to their monthly new jobs report from last year. I guess this is a two-part question. One, what did you make of the report? And I guess in two, is the Fed using the right data to analyze the labor and employment market?
So I know a lot of people talk about these revisions, and this is basically what I think about that. You want to take a crumble of paper and shoot it into the trash, because the labor market, even with the post revisions, jobs are being created. I mean, even higher than my estimates for that. I think so many people want to see like the labor data being fake, but the labor market, job openings, jobless claims, all these things have been very healthy for a long time. If anything, they're beating the numbers. My argument has been the things to watch are job openings data and jobless claims data. Why? Because that's what the Fed has told everybody to watch. And especially in the job openings data, they have a quits percentage. The Fed hates it when Americans quit their jobs and go for higher paid jobs, because that pushes wage growth. They don't enjoy wage growth accelerating, even though it peaked in January of 2022 and has been falling ever since. The quits percentage is pre-COVID. This is the key, because the Fed has a certain model to this. Job openings are pre-COVID, hires are pre-COVID. That matters more than the revisions. People focus on that. That's almost useless. The things that matter to the Fed is the labor market supply getting weaker. Now we're at the point to where if we don't print 250 to 300,000 jobs, the unemployment rate is going to start to tick up. So that should be the case for the next 12 to 18 months. Population growth is slowing here. We've already made up a lot of the COVID-19 recovery labor demand. Imagine if we didn't have COVID-19 at all. We should be between 157 and 159 million employees anyway. So we're kind of done with the tight labor market. Now we focus on sectors that can start to lose jobs, where jobless claims start to rise. So jobless claims, job openings, those are the key things for the Fed. Those things are getting weaker to the point to where the Fed finally admitted in the last meeting that that's it. We're no longer a very tight labor. Those are key things to go out for the future, which they weren't the case. But I would not spend a lot of time on the revisions, because even post revisions, the jobs data as whole has outperformed a lot of estimates. But the labor market is not tight anymore, and the Fed knows it. And so we're starting to see the stages of them moving toward maybe better language, more dovish language for the economy.
Okay. All right. I want to jump over to home price appreciation and median sales price. All right. So when you look at homes have really appreciated roughly 43% in America over the last 4 years. Even when you look at, actually, it seems like everyone's now publishing just this past week, actually really yesterday, April's numbers, and it's showing, although a slight decline, April's numbers were about 7.2% in the top, 20 major metropolitan areas, right? I guess, do you see any type of correction coming soon? Or if so, when?
So the history of nominal price declines in America going back to 1942 is extremely rare. Like, 6 years out of the last, 6, 7 decades. We had a little bit of a decline, 1% for back-to-back years in the early 1990s. Then we had the housing crash. And the reason I have fought the housing bubble boys for 13 years is that homes are much different than stocks. Active inventory is still near all-time lows. Homeowners vacancy rates are 0.8%, and there's no distress. So national price decline crashes are historically very rare. We have the best financial home loan profiles ever recorded in history. Over 40% of Americans don't even have a mortgage. The nested equity positions are the highest ever. FICO score data looks unbelievably excellent post 2010 after the QM laws are. So there is no national big price crash going to happen until you see distressed sellers and new listings data explode. So for us at Housing Wire, we track everything live. It's not fair the advantage we have because we're months ahead of everybody else, months ahead of Case-Shiller, NAR, and everybody. We see this stuff at the end of the week. And just to give everyone a good example, in 2008 to 2012, during that period, the one time since 1942 or post-World War II where nominal home prices crashed, new listings data for 4 years were running at 250 to 400,000 per week. We were seeing major distressed sellers coming into the marketplace, sellers that couldn't be buyers. So if you're talking about big national price crashes, you need distressed sellers. The last 4 years in America, as we talk here right now today, Case-Shiller Index, all-time highs. FHFA, all-time highs. 30 to 90,000 the last 3-4 years, new listings data. Seasonal curves, lowest ever recorded in history. So if you want to know why prices are still rising, active inventory is low, demand is stable, right? We're not growing demand anything, but similar to what we happened after the 1980s, right? After the 1980s with 18% mortgage rates, we had this big push in sales and a big crash. And then rates started to fall from 18, 16, 15, 14, and home prices started to rise. Home prices didn't decline back then on a nominal basis. So there's all these variables that have to happen for home prices nationally to crash. So my job is to explain why it hasn't, because home prices have. It's actually 47% going, but homeowners are pretty good, in a good spot, and most sellers are buyers. Always remember that 70 to 80% of most American home sellers buy another house. The inventory is a wash. 20 to 30% isn't. Guess what little creature of the corn doesn't provide you a house when they buy one? It's first-time home buyers, right? So millennials started to buy in 2013. Mortgage buyers take inventory off the market. I'm not a mortgage rate lockdown person, but lower rates actually don't create more active listings. It actually gives you demand. So we took the biggest brunt, the fastest home sale crash ever recorded in history. We have 3 years of the lowest home sales ever when you adjust it to the workforce. Home prices today up 6.5% year over year. So don't think of crash, think of the growth rate cooling. When you start to go into a national home price crash discussion, you're going to need new listings data to accelerate, active inventory to accelerate, price cut percentages, all the things that we track weekly. It's not there yet, right? Price growth, if anything, is going to be a little bit probably above my forecast for this year. So even with mortgage rates of 6 to 8%, the supply and demand equilibrium prevents national home prices from crashing. You need other variables to even come onto the radar first before you could have that discussion.
Okay, so so kind of taking that into consideration, or understanding that, how does that even factor in? Even when I think about the most recent CoreLogic market risk indicator report that just came out, thinking of Florida as a good example as high risk. How's that kind of sort of factor in high risk areas like Florida, where we could potentially see, significant housing price drops, like over the next 12 months, even, right? Like,
so when we think about Florida, we have to remember that the west beaches of Florida have a structural issue, right?
Right.
Insurance costs have gone up a lot.
Yep.
When we think of Florida, there are pockets of condo projects that can't get loans, right? And then the assessment costs have gone up on them. Florida is still up year over year in prices because the state has a bunch of cities that are fine, but Florida has specific issues on certain properties. To think about it in this way, when you think of Florida, think of home prices escalated out of control, then mortgage rates went up, okay? Then insurance has gone up, okay? Then you put the fourth variable, like, do you really want to buy a house in those west coastal areas of Florida if you cannot get insurance that's affordable, where home prices are, and mortgage rates at the level? So that's why you're seeing inventory pick up in certain pockets of Florida. Then it's not so bad when you think of Miami or Tampa or anything in that nature, but there are pockets of Florida that have total housing cost issues, and they have insurance issues, and then they have assessment issues on condos. You have a lot of cash buyers there in Florida because they can't get a mortgage on some of those properties. So if you don't have the migration demand or lower rates, it becomes more problematic there. That is a Florida specific issue. Even in Texas, when we think about Texas, the total housing cost of Texas is up, inventory is up there for Texas, but over 40% of all the inventory growth in America are those two states. You take them out of the equation, of course, they're outsized population states. That's it. Everything else is, majority of the country is under 2019 inventory levels. So to give everyone a reference, in NAR, National Association of Realtors information, in 2007, active listings were 4 million for the nation. Here today, even after the third year of record low sales, 1.128 million. Still well below the historical 5-decade average of 2 to 2.5 million. This with Florida and Texas being the big pushers of inventory. So Florida specific, you want to look at the pocket areas that have a lot of rebuilds and also insurance issues. Places like Miami and Tampa Bay are not as at risk as much as some of those coastal areas. But I would say Florida has a specific issue that the country doesn't have to deal with. I know here in California, we have insurance issues, but the state will give you insurance if you need it. In Florida, in some cases, people are buying homes without insurance. That's a cash buyer right there. So two different coasts, two different issues, both expensive markets to the local wages out there. Florida, I would argue, needs more migration than California does to keep it up. So you keep an eye on Florida, and like we could break down every state and zip code, but on the national stuff, it's just to have big nominal home price crashes, you need a lot more inventory. You need distressed sellers. You need demand to fall even more, or supply to accelerate out of control. We don't see that in the data yet. If anything, my inventory growth models haven't been hit so much this year, especially in the new listing side. So healthy year, I think, because we're off of the record low inventories. To give everyone an example, in March of 2022, we only had 240,000 single family homes available for sale. That's it. Now we're at 634,000 for the nation, single family homes. Normally we're 1 to 1.2 million. This is our Altos data that we have. So we're not back to normal, but we're finally getting off these levels where people have more choices. It's a good thing.
Okay, so housing inventory is really my last question in that kind of that data category I had. We're not in that. We're not necessarily in that healthy level, but we're better off than what we were. I guess really is building the next best hope that we have to kind of solve this issue. If it is, how do we incentivize builders to kind of build more?
The builders are never going to oversupply a market because that would ruin their business model.
Sure.
The builders will provide homes if they could sell them. And when they sell them, it's not an unoccupied property. So this is when I ever speak at events, I always go, how many people know how many new homes are available for sale today? Like completed closed homes ready for sale. Nobody knows because everyone's normal. Only us nerds know. There's only 98,000 new homes available for sale. That's it. They don't ever really supply a marketplace. Even during the housing crash years, it never even got to 200,000. Most of the inventory in America comes from the existing home sales market. So 2024 is good because active inventory grew, right? We were at a very, very terrible spot because price inflation could go up. Now everybody sees the last 2 years, we're averaging almost 6% a year. And that's with demand being hit. But we're finally increasing inventory, which is more supply this year than last year. Price cut percentages are increasing. That's a positive. The growth rate of pricing has already cooled down. The NAR data and everything, that's for the first half. We had very low comps on year-over-year pricing. So the growth rate of pricing cool. So considering how high rates are, it's as good as year as we could imagine. Our pending contracts data are slightly showing growth. So total existing home sales will be slightly higher. But if you get rates falling, oh my, we have so many people sitting there waiting to buy a home. But you got to get in that kind of that low sixes to get the pool of buyers a little bit bigger. And I feel so much better this year than last year, because last year we didn't get the inventory growth. This year we did. So there's more choices. So we don't have to worry about 10 to 15, 20% home price gains anymore. There's enough product out there to cool the growth rate of pricing when rates come lower.
Okay. So, all right. So that kind of wraps up, the data related questions that I have for you. Now I want to change gears and I want to ask, I want to get your opinion on a few things. And I know you have no problems of sharing your thoughts and opinions on things. So I think that,
Oh, are you kidding?
I know, right? I don't want to go total unabashed, Logan, but I do want to get your thoughts on a few things, okay? If you don't mind. And again, for those watching, for our attendees, feel free to ask questions along the way. I am monitoring the Q&A, so again, I'll do my best to weave them into the conversation. So first things first, here we are, just a few short months away from the election. Again, Logan, in your opinion, how will this year's election impact everything we just talked about? Again, Jay Powell, technically he's Fed chair until 2026. Now there are rumors that depending on who's elected, he may step down earlier. But again, how will the election impact everything we just talked about?
So I've looked back at historical elections and economic cycle data, and I don't see them being a big figure until you get a new president and if they have control of Congress to get something done. So I would overweight the labor data tenfold over the presidential election. Now we can have some volatility in the markets, when we get near election time. But as of right now, I would just say that the labor data matters more to the real estate industry because housing gets disproportionately hit to the positive side with lower rates. Doesn't matter who the president is. The labor data gets softer. Everyone in the industry is going to make more because the rates are going to go down. That's how it's worked. Post-election, unless they bring some new rules, I think everyone kind of stays in place. There's going to be probably maybe one or two resignations from the Fed boards. But I would imagine that a President Trump probably wants lower rates for just real estate, but I think he wants to kind of devalue the dollar and get more exports. So our dollar's too strong. That's one of our biggest problems if you want to export. So I would say if hypothetical Biden wins, everything kind of stays the same, but the labor data overrides him, rates go down, everyone benefits. If Trump wins and the economy is already in a recession, rates go down, you might see a little bit more push to try to bring rates even lower to try to devalue the dollar to get more exports. But overall, I just think the economic data value is more important than both presidential candidates. And the labor data is at a stage right now that it wasn't in the last 2 years where you can actually see softness. And that matters to everyone because it's not like we have credit falling, we have good demographics, we have really good home owner profiles. We just need lower rates. So the only driver I see for lower rates is the labor data getting softer more than any of the presidential candidates.
All right. So next question. You've already said this, home builders don't make money off building homes. So, building a significant amount of homes, right? They make
Home
money off
builders
building
aren't
homes.
the March of Dimes. Yes,
Right, they're
yes,
not the
they are
March of
not a
Dimes.
charity.
All right.
Yes.
So here's really, this is an important question. Should the government step in and help with really construction? Would this be more efficient than incenting or subsidizing home builders? Now I thought about this question a lot, right? And I sent this question to you ahead of our webinar, And I just started thinking about this a lot, right? Granted, we're not in a depression, and right, in many ways, we're not in a recession either, but we're very much in a housing recession, right? But it's not the first time the government has stepped in and kind of pushed things forward. And think about it. Could this be an FDR era New Deal-esque opportunity to revitalize a dying segment of our industry? And I'm really referring to lower to middle class housing. Could the government step in and really push for help with that building of a housing segment?
So I wrote this in 2021 or June, and I said, why we can't build ourselves out of this hot housing cycle. And the whole premise back then was once rates rise, um, the builders will pull back on production. So the reason we're talking about this now is because housing starts are pretty much at COVID-19 recession levels. And again, building permits for 5-unit construction for apartments are at recession levels already. And single family permits have been falling the last 3 months. The US government is buying oil at $67 to $72 to kind of refill the tank, but also to make sure that oil prices stay kind of elevated for the production. My argument is that when we see demand weakness like this or rates get too high, it affects the production of housing. So we're already at recession lows on permits. And once those apartment buildings are done, those people not only lose their jobs, but the production of future housing goes away. The Federal Reserve can step in, or federal government can step in and just pay the builders to build these homes during a time of weakness. Or they can make it a policy to keep rates low enough or provide low enough rates for builders to build apartments or anything in that nature to keep the flow going. Because when you look at economic cycles going back 5-6 decades, whenever Fed raises rates, oh my God, permits and starts fall. Here we go again. So we have this ebbs and flows. We are stuck in the business cycle. So if you want to break that, you're going to have to pay the builders to build because they're not going to do it. They are not a charity. They are they're not the March of Dimes. They are here to make money. And if the cost of capital is too much, and for a while there, we're still building single family homes, but the permits are falling now. So we're stuck in what we always get into. Rates get high enough, the production of future housing supply. The only offset against that is the federal government could come in and give lower rates or something like that to keep the process going so we don't get these periods of times where we get underbuilding. Because again, the builders won't build unless they could sell those homes. And the builders won't build apartments if the cost of capital is too much and they're going to lose money. So we're in that category right now. So the housing market, right, the existing home sales market is a transfer of commissions, right? Wages went down, jobs went down. Construction jobs are tied to the economic cycle. So we're at the point to where you could start making, we just did this in our podcast last week, the economic cycle is at risk of now losing construction labor, right? As home prices just hit all-time highs and as total inventory is so low. So the federal government can step in and maybe plug a few holes when the economies and when rates go down, then they could back off of that and let the private sector take it off. But we've seen this time and time and time again. So if you want to keep production going, you have to do something to break the business cycle, and we don't do that here. So we're always bounded by what the supply and demand economics work.
Okay. Thank you very much for that. All right. So just last week, FHFA granted conditional approval to Freddie Mac's request to buy closed-end second mortgages up to 80% of a homeowner, up to 80% for homeowners with Freddie Mac's first mortgages. What are your thoughts on their decision?
First of all, this story was so overblown. Like when it first came out, like Meredith Whitney's like, oh my God, this will be $1 trillion stimulus. I'm like, what? No, what are you talking about? So I go back to like, in the last decade, there's so much equity out there in America. We have like $52 trillion worth of home values. So, but people weren't cashing out. And how I used to explain to the media is like, well, everyone has kind of a low mortgage rate. If you do a cash out loan, your total rate goes up. So, once rates got down to, 2.75 and 3.25, it made sense for people to to do some cash outs. What we have so much untapped equity, and this plan is like not a lot of people know about what a blended rate is, a second and behind a first, if Freddie Mac does it, but it's like a capping out at 78,000, and it's a pilot program of 2.5 billion. So the product is good and fine. People just go into 2008 mode, or this is going to be a major stimulus. It's not that big of a story, but I don't see a problem with that program or the amount that they're doing. It's actually very small. So I think it was just completely overhyped because people think, oh, ATMs, cash out loans, everybody 2008 all over again. No, it's not. It's not even close. So fine product, not that big in scale terms. They'll probably run the test pilot at $2.5 billion. They're going to come in and buy, and then they'll take it from there. So not that big of a deal, but man, the story got wild there for a second.
It sure did. It sure did. All right. So you talked a lot about the spread. Moving on to the next part. Again, you talked a lot about the spread. And then this is something that the mortgage industry, not so much, the mortgage industry as a whole, that's been pushing for something really that's been going on for the past, at this point in time, handful of years. Should the Fed or GSEs, depending on how you want to frame it up, stop quantitative easement and start buying mortgage-backed securities again?
So the spreads have been bad for a while, but traditionally speaking, when the Fed starts cutting rates, they do get better. We've had many decades and many economic cycles where the spreads get worse when market are stressed and there's business risks. So the spreads are getting a little bit better now. You don't necessarily need mortgage-backed securities purchases, but you do need the Fed to start cutting rates for that. So it's a more effective way if you wanted to have the government tell Freddie and Fannie to buy mortgage-backed securities just to get a little bit better pricing. I mean, let me put it to you this way: if we had normal spreads today, mortgage rates are 5.875. We're sub 6%. Just normal, just going back to the historical normals back to 1971. That's where we would be. So the only thing is that the Fed themselves are just a bunch of crybabies. My God, when mortgage rates got to 6%, they came on TV and they're like, oh my God, people are buying homes and having sex, and how we're supposed to fix the economy if this happens. And I'm like, really? 6% mortgage rates? You're already crying. So I don't know if the Fed will ever even engage in that discussion. But if the government wanted to, because Freddie and Fannie are still in conservatorship, authorize some kind of purchases of mortgage-backed securities, maybe they're loosening things up. But when the Fed cuts rates and the labor market breaks, rates are going to go down. The spreads should get better in that moment. And then, oh my, you could have the double whammy effect. You could get the falling 10-year yields and better spreads. You know what that means? That means you could get a sub 5% mortgage rate again in that category. So again, the potential for rates to get better are there. They do need the labor market breaking. They do need the Fed to start being more dovish, cutting rates, because you got the spreads and the 10-year yield coming together. So there's a lot more downside on rates than upside coming here, especially where the labor market is. But yeah, you can have a double whammy effect, and that's better than giving people $400 check each month, whatever, for housing. You could initiate mortgage-backed security spreads. I doubt the Fed gets involved in it. They're too much of a babies, but the government can issue something and the spreads get better. And think about it, just 6% mortgage rates would change everything. I mean, you're not going to be booming in sales, but more business, more home sales could rise and stay up there. We could get things moving again. But don't look for the Fed to do anything like that. Maybe the federal government's issues an order to do mortgage-backed securities. That it doesn't take much to move the needle. I mean, we could get just normal spreads changes everything. But if the 10-year yield falls, oh, that's a double whammy effect there.
Okay, that's awesome. Last question. And it's really any final thoughts or words of wisdom?
My work is very nerdy, but I promise you, I try to make economics as fun as possible. But we believe that people that actually track economic models have an edge over what you guys see out there on YouTube and TV and TikTok. And oh my God, it's such trash. So my job is to basically try to explain to everybody what's going on with the data. And traditionally, that's really boring. Like economics is not really designed to be this fun, sexy thing. It's really a boring, just kind of modeling out there. And unfortunately, the doom porn sells out there. But I promise you this, if you guys follow me, I will get you all to understand how housing economics works. And our data is fresh and live. Like we have such an unfair advantage over everyone. But this way you as a professional can talk to your clients. And I always say, everyone has an Uncle Dave. There's an Uncle Dave at every Thanksgiving who says it's housing 2008. You could take Uncle Dave down with actual data. And you don't have to be an economist, trust me, to understand some of this stuff. So what I would tell you right now is that I can explain this stuff so things can be easy, but you can also explain to your clients. And knowledge is, to me, is always power, because when you spread your own knowledge, then you are always that source of the knowledge. And when you're a source of the knowledge, you get trusted out there. Now, I'll try to spice things up to make it as fun as possible. But again, I'm bounded by the laws of math, facts, and data, and not storytelling. So there is a potential for things to get better in the industry. That's in the third calendar year of a recession, but there's certain things that need to happen and certain things to track. So if you need the real goods, I'm your guy.
Awesome. Well, Logan, thank you very much for your time. Really do appreciate it. And I'm really looking forward to your session at our annual conference this September.
Oh, the live events are 10 times better than anything. So it is going to be a lot of fun. And I tell you, every live event we do, we always get like 5 or 10 offers, because we try to make economics so much fun. And it's so visually, easy to understand the charts that we bring out there. And we see iPhones, like concerts, people snapping stuff. And we're here to teach and to make economics fun, so you become a better professional in your own industry.
Awesome. Again, Logan, thank you very much.
Pleasure to be here.
All right. Once again, thank you to Kelly Hembaugh and Constellation Mortgage Solutions for sponsoring today's webinar. And again, to Logan for his valuable insight. And to all of you, thank you for attending today's webinar. Your time is valuable, and we appreciate you spending the better part of an hour with us today. We hope you enjoyed today's session. We appreciate that 45 minutes isn't nearly enough time to cover everything on this topic. So if you want to learn more and continue to fine-tune your knowledge, I would recommend attending one of our upcoming events or listening to one of our podcasts, where you'll find that we'll continue to expand upon this topic and much, much more. Head over to www.acma.org or our community page for more information on the latest updates on everything happening over here at Acma. Until next time, be well, my friends. Bye.